Do you remember the autumn of 1998? For a fortnight that September, the news kept telling you that a fund in Connecticut, which almost nobody had heard of, might take the world's banking system down with it. You will probably remember that it was rescued. What you were almost certainly never told is that it had been right. Nearly every trade on its books eventually made money. It was destroyed anyway in 4 months by a single assumption that every one of them had got wrong. In the 4 months between May and September of 1998, a private investment fund in Greenwich, Connecticut, lost about $4.6 billion, more than 9/10 of everything it had. 2 of the people who worked there had won the Nobel Prize in economics the previous year. On the 23rd of September, the president of the Federal Reserve Bank of New York put the heads of 14 of the largest financial institutions in the world into a room on Liberty Street and did not let them leave until they had agreed to buy it. No public money was spent. The Fed lent nothing and guaranteed nothing. What it did was arrange a meeting, and the reason it thought a meeting was necessary is the whole point of this story. Because the fund's positions were not, in the main, wrong, almost all of them eventually made money. This is the story of how a portfolio that was substantially correct destroyed itself anyway, and of the specific thing that everybody involved had measured incorrectly. Long-term capital management was founded in 1994 by John Meriwether, who had spent the previous 15 years at Salomon Brothers building and running the most profitable trading operation on Wall Street. His group at Salomon was called Fixed Income Arbitrage. It was small, secretive, staffed largely by academics rather than traders, and in some years it produced a substantial share of the entire firm's profits. Meriwether left Salomon in 1991 in the aftermath of a scandal on the government bond desk that he had not caused and had reported. When he set up on his own, most of that group came with him: Larry Hillebrand, Eric Rosenfeld, Victor Haghani, Greg Hawkins, men who had built the models and knew exactly which trades the models found. And then he did something that had never been done in that business. He recruited the theory itself. Myron Skoll and Robert Merton joined as principals. Between them, with the late Fisher Black, they had produced the option pricing framework that made the modern derivatives market possible. And in 1997, they shared the Nobel Prize in economics for it. David Mullins came too, and his arrival said something different again. He had been vice chairman of the Board of Governors of the Federal Reserve System, the number 2 official in American central banking, and he left that job to join a hedge fund in Connecticut. The fund opened for business in February 1994 with about $1.25 billion, which at the time was the largest launch anybody had ever raised. The terms were correspondingly severe: a $10 million minimum, a 3-year lockup on the money, a 2% management fee, and 25% of the profits. Those are terms a manager can only demand if the investors believe the returns will be exceptional. For 4 years, they were. After fees, the fund returned roughly 20% in its opening partial year, then about 43%, then about 41%, then about 17%. So the obvious question is what they were actually doing, and the answer is much less exotic than the reputation suggests. Strip away the mathematics, and it is one idea, applied with great discipline and enormous quantities of borrowed money. The idea is convergence. Find 2 securities that are economically almost identical but trade at slightly different prices. Buy the cheap one, sell the expensive one, and wait for the gap to close, which it must, because the 2 things are the same thing. The textbook example is the American Treasury market, and it is worth walking through slowly because everything that happened later is contained in it. The Treasury issues a new 30-year bond periodically. The most recently issued one is called the On-the-Run bond. It is the one everybody trades, so it is easy to buy and easy to sell in size at a good price. The bond issued 6 months earlier is nearly identical, same government, same credit, almost the same maturity, but it is no longer the one everybody trades. It has settled into portfolios. Selling a large block of it takes longer and moves the price more. Because of that, it yields slightly more. Investors pay a small premium for the liquid bond, which means the illiquid one is a fraction cheaper. The gap is small, a handful of basis points, hundredths of a percentage point. Here is what makes it a trade rather than an observation. In 6 months' time, when the Treasury issues the next bond, today's on-the-run bond becomes off-the-run itself. The premium it currently carries will disappear, because the thing being paid for is a status it is about to lose. So you sell the expensive one, buy the cheap one, and hold. The convergence is not a hope, it is close to a scheduled event. The problem is the size of the prize. A few basis points on a bond is a rounding error. To turn that into a return an investor would notice, you have to do it in a position measured in billions. And to hold a position measured in billions, you have to borrow almost all of it. Which is exactly what they did, and the borrowing was the cheapest part. Government bonds are the best collateral in the world. A dealer lending against them in the repo market takes a haircut, the margin of extra collateral that protects the lender if the price moves. For most borrowers, that haircut is a couple of percent. For long-term capital management on many trades, it was close to zero. The banks competed for the business, and the way they competed was by asking for less protection. The result was a balance sheet that is hard to hold in your head. By early 1998, the fund had roughly $4.8 billion of its own capital and something like $125 billion of assets. That is leverage of about 25 to 1. And that figure understates it because it counts only what sat on the balance sheet. The notional value of the fund's derivative contracts, swaps, options, futures, has been estimated at around $1.25 trillion. Now, 25 to 1 sounds reckless, and the defense offered at the time was serious, so it deserves to be stated properly rather than dismissed. Leverage is only dangerous in proportion to the volatility of what you own. A portfolio of technology stocks at 25 to 1 is suicide, because those prices move 10% in a week. A portfolio of near-identical government bonds hedged against each other is a different animal. The position is not a bet on interest rates. It is a bet on a tiny spread between two almost identical things. Hedged that way, the daily fluctuation of the whole portfolio was genuinely small. The risk models, value at risk calculations built on years of price history, said that a loss of the kind that eventually occurred was so improbable that it should not be expected within the lifetime of the universe. The second defense was diversification. This was not one trade. It was hundreds spread across countries and asset classes. Danish mortgage bonds, Italian government debt against German, swap spreads in half a dozen currencies, merger arbitrage in equities, long-dated index options. If those positions were unrelated to each other, then the portfolio's overall risk was far lower than the sum of its parts, and the leverage was justified by the diversification. That sentence is the load-bearing wall of the entire enterprise, and there is a word in it doing all the work. The word is unrelated. Hold on to it. Two of the trades are worth setting out in detail, because between them they explain everything that followed better than any summary can. The first is a pair of shares. In 1907, two oil companies, Royal Dutch Petroleum of the Netherlands and Shell Transport and Trading of Britain, merged their operations while remaining separately listed. The agreement split the combined cash flows on a fixed basis, 60% to the Dutch company, 40% to the British one. That is as close to an identity as financial markets offer. Two claims on the same set of assets in a fixed and permanent ratio. The prices should therefore stand in that same ratio, always. They did not. For decades, the two shares deviated from the 60-40 relationship, sometimes by several percent, occasionally by considerably more, with the Dutch shares generally the expensive ones. The gap moved around for reasons that had nothing to do with oil, which index each share sat in, which countries investors were buying, tax treatment of dividends. To a convergence trader, this is close to a gift. Sell the expensive claim, buy the cheap one in the correct proportion, hold and collect when the market notices its own absurdity. The fund put on the trade in size. The gap did not close. During 1998, it widened, which produced losses on a position that was, in the most literal sense, arithmetically correct. And it stayed wide for years afterward. The two shares did not finally converge until the companies formally unified their structure in 2005, 7 years later. That single trade is the thesis of the entire episode. The position was right. It required a holding period of 7 years and the patience of an investor who could not be forced to sell. Long-term capital had neither. The second trade is stranger, and it took the fund a long way from bond arbitrage. It was selling long-dated options on equity indices. The reasoning was ordinary. Insurance companies and pension funds in Europe and America wanted long-dated protection against a market fall, and there were very few natural sellers of a 5-year option on a stock index. That imbalance meant the implied volatility built into the price of those options sat persistently above the volatility actually observed in the market. So the fund sold them, in enormous quantity, hedging the direction and keeping the difference between implied and realized volatility. It became such a dominant supplier that traders on other desks referred to it, half seriously, as the central bank of volatility. Notice what that position is underneath. It is a promise to pay out if markets become turbulent, sold by a firm whose entire portfolio also loses money when markets become turbulent. It was not a diversifying position at all. It was a second, much larger bet on the same weather. And when the flight to quality arrived in August and September of 1998, implied volatility went to levels nobody had priced, and those options were marked against the fund on a scale that dwarfed the bond positions. The insurance policy it had written came due in exactly the week it could least afford it. Between them, the two trades show the shape of the problem. One was correct and unfundable. The other was profitable in every ordinary month and catastrophic in the single month that mattered. Neither was a mistake of arithmetic. By 1997, a different problem had appeared, and it is the one that never gets enough attention. The fund was too successful for its own strategy. Convergence trades exist because somebody is willing to pay a premium for convenience. That premium is finite. When a fund with billions of dollars puts on the trade, the spread narrows, and it narrows for everybody. The opportunity shrinks as you exploit it. By late 1997, the partners could see it happening. The trades they liked were thinner than they had been, and the fund had more money than it had good places to put it. So in December 1997, they did something that looked like admirable discipline. They returned about $2.7 billion of capital to outside investors. Look carefully at what that does. The position stayed roughly where they were. The capital supporting them was cut by more than a third. Leverage on the remaining base went up sharply. It was framed as returning money because the opportunities were shrinking, which was honest. Its effect was to make the fund considerably more fragile going into the worst year in its history, and to concentrate the exposure in the hands of the partners themselves, who kept their own money in. Then came 1998, and it began going wrong quietly. Spreads in mortgage-backed securities widened rather than narrowed in the spring. May and June produced losses, modest, unpleasant, within the range of things that happen. There was also a development elsewhere that mattered more than anyone outside a few trading floors realized. Salomon Brothers, by then owned by Travelers, shut down its bond arbitrage unit in the summer of 1998, the very desk that had spawned long-term capital. That desk held many of the same positions, because it had been built by the same people using the same logic. Closing it meant liquidating those positions into the market, which meant that the spreads long-term capital owned were being pushed the wrong way by somebody, unwinding an almost identical book. The proprietary insight, it turned out, was not proprietary. Copies of the portfolio existed in several places, and the exits were the same door. And then, on the 17th of August 1998, the government of Russia devalued the ruble and defaulted on its domestic debt. The direct exposure was survivable. The consequence was not, and the mechanism deserves to be stated in plain language, because it is the single most important thing in this entire story. When investors are frightened, they do not sell everything equally. They sell what is hard to hold and buy what is easy to sell. Money runs, all at once, toward whatever is most liquid in global markets. That means the newest American Treasury bonds, and away from everything else. Now go back through the portfolio. Long-term capital was short the liquid bond and long the illiquid one. Short the safe credit, long the risky one. Short the easy to sell, long the hard to sell in Denmark, in Italy, in mortgages, in swaps, in equity volatility, in every one of those supposedly unrelated markets. Every trade in the book was a different expression of the same underlying position. Sell liquidity, buy illiquidity, collect the premium. In normal times, those trades genuinely have little to do with each other. In a flight to quality, they are one enormous bet, and it goes wrong everywhere simultaneously. That is what the models had got wrong, not the mathematics, which was fine. The assumption underneath it, that the historical correlations between these markets describe their relationship in all conditions. Correlation is not a property of a market. It is a property of who owns the positions, and how much they have borrowed, and what happens to them when they need cash. In a panic, everything owned by leveraged holders becomes correlated, because it is all being sold by the same people for the same reason on the same afternoon. On the 21st of August 1998, the fund lost about $550 million in a single day. Over the month of August, it lost roughly 44% of its capital. On the 2nd of September, Merriweather wrote to the fund's investors and told them the number. The letter said, in terms, that losses of this magnitude were a shock, that the fund's positions were fundamentally sound, and that the opportunity available was now the best it had ever been, and it invited new money in on favorable terms. Every sentence of that was defensible. It was also the single worst thing that could have happened, because the letter did not stay private. Within days, its contents were circulating on trading floors, and the market now knew that a heavily leveraged fund with famous positions was badly wounded. What follows is the part of the story that anyone who has ever been in a distressed position will recognize, and it has nothing to do with mathematics. Once your counterparties know you are in trouble, the market stops being an abstraction and becomes a group of people who can see you. The dealers financing the fund knew its positions because they had financed them. They could work out what it would have to sell. So the spreads moved further against it. Not in the main from conspiracy, simply from a large number of firms independently deciding to reduce their own exposure to the same trades and to avoid being the last buyer of something a forced seller was about to dump. Meanwhile, the mechanics ground on. Every day, positions were marked to market. Every adverse mark produced a margin call. Every margin call had to be met in cash. And meeting it meant selling something into a market that had already worked out you were selling. This is where size stops being an advantage and becomes the central problem. The models valued the portfolio at market prices. But a market price is the price of the next small trade, not the price of your entire position. If you own a large fraction of the outstanding supply of an instrument, there is no price at which you can exit quickly. The exit price is whatever a distressed buyer chooses to offer, and the difference between that and the model price is not a modeling error. It is the cost of being big. By the middle of September, the fund's capital had fallen from about $4.7 billion at the start of the year to a few hundred million, while it still had something like $100 billion of assets on its books. At that ratio, the arithmetic ceases to mean anything. A 1% move against it wiped out everything remaining several times over. The partners went looking for capital. Merriweather approached, among others, Warren Buffett, George Soros, and a series of banks. In late September, a consortium of Berkshire Hathaway, Goldman Sachs, and the insurer AIG made a formal offer, roughly $250 million for the portfolio itself, plus around $3.75 billion of new capital to run it. The offer would have wiped out the existing partners almost entirely, which was the point of it. It lapsed within hours, over a genuine legal question about whether Merriweather had authority to sell the fund's assets out from under his partners in that form. And at that moment, the problem stopped being a private one, because of what the Federal Reserve Bank of New York had just learned. The New York Fed had sent people, including its head of markets Peter Fisher, out to Greenwich to look at the fund's books. What they found was not simply a large fund in difficulty. It was a fund that sat at the center of a web of contracts with every significant dealer in the world. The exposure was not primarily lending. It was derivatives, thousands of swap and option contracts, each with a counterparty on the other side, each of them assuming that when the contract came due, the other party would perform. If the fund defaulted, those contracts would terminate simultaneously. Every counterparty would seize the collateral it held and sell it, all at once, into markets that were already in a flight to quality. Each firm would be acting entirely rationally, and collectively, they would be dumping tens of billions of dollars of the same positions into a market with no buyers. Worse, no individual bank could see the whole picture. Each knew its own exposure and had no idea how much of the same risk its competitors held, which meant that in a default nobody would know who else was hurt, and the sensible response to not knowing is to stop dealing with everybody. That is systemic risk stated precisely. The danger was never that a hedge fund would lose money. It was that the liquidation of a hedge fund would be conducted by 100 frightened firms at the same time. So on the 23rd of September 1998, William McDonough, the president of the Federal Reserve Bank of New York, convened the principals of the major banks and securities firms at the Fed's building on Liberty Street. The proposition put to them was blunt. Either they collectively recapitalized the fund and wound it down in an orderly fashion over months, or they each took their chances in a disorderly liquidation, whose costs none of them could estimate. 14 firms agreed. They put in about $3.625 billion in exchange for 90% of the fund, and installed their own oversight committee to run the wind down. The existing partners were left with a residual stake and no control. One firm refused. Bear Stearns, which was the fund's clearing broker and therefore knew the positions better than anyone, declined to contribute. The decision was remembered by the other firms in the room, and it will come back at the end of this story. The Federal Reserve did not lend a dollar to long-term capital management. Its contribution was the room, the convening authority, and the implied message that the alternative was worse for everyone present. That distinction matters enormously to the argument about what happened next. Separately, the Fed cut interest rates 3 times that autumn, in late September, in the middle of October, and again in November. Whatever the official reasoning, it worked. Markets calmed, the flight to quality reversed, and spreads began slowly to converge. Which is the most uncomfortable fact in the whole affair: the trades were right. Over the following year, the portfolio was wound down profitably enough that the consortium recovered its investment with a small return by 2000. If the fund had been able to hold its positions for another 12 months, it would have made money on most of them. It could not hold them for another 12 months because holding a position requires funding it every single day, and the market decides whether you get to. The investors who had been in from the start lost the overwhelming majority of what they had. The partners lost most of their personal fortunes, having kept their own capital in the fund, and in several cases borrowed to invest more of it. That is worth noting against the standard telling. This was not a case of managers walking away rich. One thing before we go on. If you subscribe, it genuinely helps this channel keep going, and there is a new piece of American financial history every single day. And leave a comment while you are here. It matters more than you would think. Meriwether started another fund in 1999 and ran it for a decade before closing it in the crisis of 2008. Scholes and Merton returned to academic and advisory work. Mullins did not return to public office. So what should be taken from it? There are 5 lessons, and only the first one is usually stated. The first is the one everybody knows. Leverage magnifies. 25-to-1 means a 4% adverse move destroys you. Everyone involved knew this perfectly well, and it is the least interesting lesson available. The second is the important one. Diversification is not a property of a list of positions. It is an assumption about how those positions behave together under stress, and that behavior is determined by who owns them and how they are financed. The fund held hundreds of trades in a dozen markets on 3 continents. On paper, that is a diversified book. In reality, every one of those trades was financed the same way, held by the same kind of leveraged investor, and would be sold under the same conditions. It was one position wearing many hats. The general form of that lesson is that correlation is endogenous. Assets are not related or unrelated in themselves. They become related when the same balance sheets own them, and the more crowded a strategy becomes, the more tightly its components move together in precisely the conditions where you need them not to. The third lesson is about the difference between a price and an exit. A risk model treats the market price as the value of a position. That is true for a small holder and false for a large one, and there is no clean way to write the difference into a model, so it usually is not written in at all. If your position takes 3 months to liquidate in normal conditions, then in a crisis your true holding period is 3 months whether you like it or not. Liquidity is not a market characteristic. It is a relationship between the size of your position and the market's capacity to absorb it, and it evaporates exactly when it is needed. The fourth lesson concerns what history can tell you. The models were calibrated on years of price data, and the data were real. The problem is that the sample contained no example of the event that actually occurred, and a statistical model has no way of knowing what is missing from its inputs. Rare events are not rare in the way the arithmetic implies, because financial markets are not a natural process generating independent draws. They are a system of people who copy each other, which produces long, placid stretches and sudden, violent breaks. And a model fitted to the placid stretch will always understate the break. The fifth lesson is about the lenders, and it is the one the industry has had most difficulty with. The banks that financed the fund did not have to lend at almost no haircut. They chose to, because they were competing for the business of the most prestigious client in the market. That competition removed exactly the protection that would have limited the damage to the lenders, to the fund, and to everybody else. Every one of those banks then sat in a room at the Federal Reserve, discovering that their competitors' credit decisions had become their problem. Which brings us to the argument that has run ever since, and it is worth taking seriously on both sides. The case for what the Fed did is that it spent no public money, took no risk onto its balance sheet, and prevented a disorderly liquidation whose cost would have fallen on people with no connection to the fund. It was, on this reading, a fire warden clearing a building. The case against is that it established something. It demonstrated that a sufficiently interconnected private institution, not a bank, not regulated as one, not insured, could reach a point at which the central bank would organize its rescue. Once that is known, it changes behavior. It makes size and interconnection valuable in themselves because they buy a seat at that table. And the people who lend to such institutions will price their loans accordingly, which means the market's own discipline is weakened precisely where it is needed most. There is no clean answer to that argument, and anybody who offers one is selling something. What can be said is that the mechanism was documented at the time in public by the people responsible. In April 1999, the President's Working Group on Financial Markets, the Treasury, the Fed, the Securities and Exchange Commission, and the Commodity Futures Trading Commission published a report titled Hedge Funds, Leverage, and the Lessons of Long-Term Capital Management. Its central conclusion was that the problem was not hedge funds as such. It was excessive leverage extended by regulated institutions to unregulated ones, without adequate information about the total position, and it recommended better disclosure, improved counterparty risk management, and closer attention to concentration. Read that sentence again, and then consider what happened over the following decade. Regulated institutions extending very large amounts of leverage against instruments whose liquidity was assumed rather than tested, with no participant able to see the aggregate position. The report identified the mechanism of the 2008 crisis 9 years early and named it accurately. What it did not do, what a report cannot do, was change the incentives that produced it. And here is the detail that makes the point better than any argument. Bear Stearns was the one firm that refused to contribute to the rescue in 1998 on the reasonable ground that it was not its problem. In March 2008, Bear Stearns found itself unable to fund its own positions, highly leveraged, in instruments that had become impossible to sell at model prices, with counterparties withdrawing overnight. It was sold to J.P. Morgan in a weekend, in a transaction arranged by the Federal Reserve Bank of New York, with public support this time. The mechanism that destroyed it was the same mechanism, exactly. A portfolio that was fine as long as it could be financed, and a market that stopped financing it. Nor did it end there. In March 2020, as the pandemic hit, hedge funds were again running a large leveraged position in the American Treasury market. The basis trade, buying cash bonds against short futures, financed in the repo market at very high leverage. When the flight to cash came, that trade was unwound at speed, and the market in United States Treasury securities, the deepest market on earth, briefly stopped functioning properly. The Federal Reserve bought hundreds of billions of dollars of treasuries in a matter of weeks to restore it. The trade was, once again, a convergence trade between two nearly identical instruments, held in enormous size, financed daily, and correct in the long run. Which is the note to end on, and it is not really about hedge funds at all. Long-term capital management was not destroyed by being wrong. It was destroyed by the gap between being right and being able to wait. Everything in its portfolio depended on the willingness of other people to keep lending against it every morning, and that willingness is not a fact about the assets. It is a fact about the mood of the lenders. Any position financed with borrowed money contains a hidden second bet that you will still be able to borrow tomorrow. That bet is invisible on the balance sheet. It does not appear in the risk model, and it is the one that decides whether you survive. It is also why the people who survive these episodes are so often the ones with the least impressive returns in the good years. Funding stability is expensive. Holding more cash than you need, borrowing less than you are offered, and running a position you could actually exit all cost performance in every quarter except the one that matters. And the cost is visible every quarter, while the benefit is invisible forever, because it takes the form of a disaster that did not occur and therefore never appears in any report. Nobody has ever been praised for the crisis they did not have, which is the underlying reason this keeps happening, and why the lesson has to be relearned by a new set of extremely intelligent people roughly once a decade. Which is why the useful question to ask of any strategy is not how likely it is to be right. It is a much duller question, and it is this: if this position moves against you for 90 days, who has to agree for you to still be holding it, and what would make them say no? Sources for this account include the April 1999 report of the President's Working Group on Financial Markets, Hedge Funds, Leverage, and the Lessons of Long-Term Capital Management, the testimony of Federal Reserve officials before the House Committee on Banking and Financial Services in October 1998, the General Accounting Office's review of the episode, contemporary financial press reporting of the September 1998 recapitalization, and the published accounts of the fund's strategies by its principals and by subsequent researchers.